Aloha, this is Joshua Hayes at BigWaveTrading.com with the October 7th market report to help you get ready for October 8th. Well, yesterday I have to admit, there was a nice intraday reversal near the end of the day that, as you can see here, gave the S&P 500 a little tail here on higher volume. That came also on the NASDAQ, which even had a more bullish intraday reversal, showing what could be a possible hammer pattern, especially on the very strong volume. Well, all of that possible bouncing patterns that showed up in the Dow Jones Industrial Average, S&P 500, and NASDAQ were all destroyed today when the Dow Jones Industrial Average rolled over to a new low on volume that was much higher above average, not higher than the day before. The NASDAQ did the exact same thing, rolling over to new lows, ending the possible rally attempt. A much higher volume than the average, but still below yesterday's sell-off. So it wasn't a complete distribution day. And looking at the NASDAQ 100, you see the same thing. The lows yesterday were 1339, and they got a 1329 close. So more new 52-week lows. Volume wasn't higher than the day before, but much higher than the 50-day volume average. Just showing you that the sell-off remains intact. If you can have a nice intraday reversal at the end of the day like that, that can bring the markets off their lows and near the where they open after the gap down, like you can see here on the NASDAQ 100, and then the very next day, you just forget all about it. Did we go to a new low there? 1339, 1329, yeah. So just the way that we rolled over from the possible bouncing area yesterday, since we're so far below the 15-200-day moving average, seems more plausible that bounce could work here. But it didn't. It failed, and that's what pretty much I expected almost 80%. I was only like 20% sure that we could continue to bounce. That's why I only figured it a couple of days. That's why there was only one new long instead of like 5 or 6 new longs. The facts are that there's not a lot of nice charts out there at all now. And for the first time since I began writing my blog in 2005 in March, I have no longs in my watch list that I'm even looking at possible future longs. So today is the first day in my gold forums that I've had to write under possible future longs. Nothing. So that should tell you a lot about the market right now. It's not that bullish, period. It's just not good. I mean, there's no other way of putting it. The rollover continues. Arithmetic chart makes it look like it's been way too, extreme on the selling, but a weekly chart shows that, the 2002 lows to the 2008 current prices is only a 44% gain, and I could see the NASDAQ easily losing 44% gain, especially, we're on a 3-day, so let's go to a weekly. Look at this weekly chart closely. Look at 2007 going into the top. 1, 2, 3 key distribution weeks. 1, 2, 3, 4, 5 key distribution weeks at the top. And then after a low volume bounce and then rollover, 3 increasing weeks of distribution. And then you can see 3 weeks of lower prices in this flat area. The potential move higher is on lower volume, and then as it stalls at the 250, you get heavy red volume on the weekly. And as you saw, 1, 2, 3, 4, 5, 6, 7 weeks of selling off before you hit the July, August, September period. And then even after that, as you can see recently, 1, 2, 3, almost 4, 5 straight weeks of a sell-off on heavier volume above the 50-day volume average. So it's not too healthy out there, and all these indexes are in pretty bad shape, including the S&P 600, which got walloped 5.58%. And then look at the Russell 2000 getting a 6% trim. And that's just not good. That's just an ugly 6-day chart. Look at how tight all these price bars are from 2003 to 2006. 2007, for the first time, it widens up and it's to the downside. And that continues. And now you have another 2 weeks in a row of very heavy distribution. And that leads up to 9 days, a drop of 20%. Excuse me, on the Russell 2000. So that's just not bullish. So overall, all these indexes are very ugly. And while they remain below the 50-day moving average and 200-day moving average, which is the white and purple line, there is no reason for newbies to play the stock market until you see the price bars, which are clearly under the 200-day moving averages and very bearish patterns. There is just no way you can get bullish on this market. There is one area I can get bullish on, the United States dollar. Notice how I tell you don't buy stocks until they're above the 250-day moving average? If you did that here with the U.S. dollar, you still have an 8.67% gain after today's 0.9% loss. But I want you to notice something about today's 0.9% loss. It was much better than the market's 5% loss, which caused the relative strength line, the white line, to hit a new high while prices dropped a little bit. And as prices dropped, as you look closely here, you've got a bullish tail. You got a tail here, no need for a tail there. Tail, 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 tail. Bullish, 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 bullish. Even on a down day, that's bullish action coming well off the lows, giving me a tail. So even the United States dollar is proving that if you would wait until the price is above the 50 and 200-day moving average, and then preferably wait till the 200-day moving average or the 50-day moving average is above the 200-day moving average when it comes for stocks. When it comes to these commodities, currencies, right here was the buy when it got above the 250-day moving average. You got to just move a little bit more quicker and cut your losses faster. So I'm a little bit more tight with my risk reward scenarios if I would ever go back into the currency market, which I might. I mean, I've done pretty well at gauging the movements in these currencies recently. So in the future, if stocks don't bounce back hard and we got a futures market that's working, I'll probably be going that direction. But for right now, I mean, we can look at all the indexes. I mean, let's go on a zoom too from the top in October that we were talking about. As you can see, from the highs in October to about now in the S&P 500, you've got a 36% loss. I think that goes with like Kramer's 32% loss year to date. So you know what? My worst account is down 7%, and that is my girlfriend's account that she gave to me on November 1st, the day after the stock market topped, according to the NASDAQ, which was October 31st. So my girlfriend is giving me her account to work with in a bear market. And during the rally from March to May, I tried to make some money, and I did make a few dollars back because I was down like 10%. But I finished with a down 7%, and I was pretty upset because I'm not used to having losing returns, which obviously the rest of Wall Street is. So I don't know why I don't get any FaceTime anywhere with the returns that I've been posting on the blog since 2005, posted in 2002 in Telechart whenever I was making tons of notes, and then all my 1999 and early 2000 winners in the Tokyo Joe chat room. I just don't understand why I don't have a following at all. But since October 31st, the market is down 38%. My girlfriend's account is down 7%. My top portfolio, thanks to all of my shorts, which have 25% to 60% gains in the past 3 months, has increased me from a 10% to right around a 19% return. And after today, I'm sure it's 2021. I still have not entered any sells, profit-taking orders on my shorts. And I know that there's 3 I have to. I might as well tell you guys them. HXM, SPW, GGB. If you don't know, GGB is up 55% for me. HXM is up 52%. and SPW is up 58% in a very short amount of time. So not only can I make a ton of money in bull markets, I can make a ton of money in bear markets. But you know what? I'm pretty disappointed with myself. I'm about 90% cash, 9% short, 1% long, probably less than 1% long.